Welcome to the Daily Update, where I'll go over the action in the market for Friday, November 3rd, and then we'll see how things look for Monday, November 6th. We had another up day. We're going up pretty far, pretty fast. So in the short term, we're starting to get some extreme positive readings, and we're coming right up to resistance that I'll tell you about here and show you as I go through the charts. But things are switching back more positive. We still have, for Monday's session anyway, positive seasonality, and we're coming into more of the month of November now, which tends to be the best month out of the whole year. So before I get started, I have been having some problems uploading to Rumble. Thursday's video is still out there just churning, trying to become ready to watch. Friday, I was able to upload everything and it went just fine, even though it was slower than usual. So if you have trouble and you're on Rumble, you can't find the video, please, if you feel comfortable with that, switch over to YouTube. And the same goes true. There are times when YouTube runs into trouble, and then I post over to Rumble. So you can look in both places, and I'll get those posted as soon as I can. All right, let's go back and talk about what happened. At the open, we had another gap higher open above R1 at 43.36. And then we also went above R2 at 43.53. The action was pretty much the same on Friday that we saw on Thursday. Then prices drifted higher and lower, just kind of flowed a little bit higher, a little bit lower. But we stayed above R2 and we closed off of the high. But it's Friday. We've had a good run up. I don't necessarily think that should be taken as something negative. We'll have to see. We were up 0.94%, and we're still above average with volume. Our technicals are positive now, and some are in the process of turning more positive and more in the intermediate term, but we're getting more overextended in the short term. And the big reason on Friday was interest rates really dropped. My goodness, just a week or so ago, we were dealing with 5%. Now we're back down to 4.5%. And for those movements that we're seeing, that's pretty significant for interest rates to move down that far, that fast. Excuse me. And it's dealing with inflation as well. That seems to, for right now, to be more under control, or at least the market is willing to accept what's happening there. We're also seeing a bit of a slowdown in the economic reports. We had the Being Employment Situation Report, and I'll go through that. And then geopolitically, we're keeping an eye on what's happening in Israel, wondering if that's going to escalate, or to put it another way, continue to escalate. Some comments. Apple did decline after reporting earnings. Now, this could have just taken the whole market and dropped everything right there. Apple is such a big company. They're so influential. The fact that they were down could have really had an impact on the market. In fact, they were down quite a bit, and then they ended up closing down, but well off of the lows. The S&P did get back above its 50-day moving average, so we're starting to reclaim some territory here, which right now is at about 43.47, and we're also above the August 2022 high. These are positive things. We're taking areas of support and resistance and actually going above them. Then this was another broad-based rally, and as interest rates fell, that's the real impetus that they're giving for that. The one area of concern, and I have some charts to show you this, growth is still lagging. In fact, it's actually underperforming value. And we did see small caps were really strong, but we need to see more than just one day of small caps really kicking into gear to turn things more positive. Oil was down. That also helped the market. We're down at the 80.78 level, where not too long ago we were hitting 95 with oil. And here's our list of the short-term extreme positive readings. We have the Stochh RSI and the Williams %R, two very touchy short-term indicators. Just the CCI 14, the 20 isn't quite there yet. Our short-term stochastics, the force index, which was already on the list, and the rate of change going back 5 periods. We're seeing a little bit in our intermediate term. This could still go higher from here, but we're also at some resistance. We have the CMB Composite Index, the Connors RSI, which was already on the list, the PMO studies, just one area of that. And now we have both the S&P and the NYSE McClellan Oscillator starting to get extreme negative. Now, they could keep going up from here. These are just areas we want to be aware of. We're still going through this basic scenario. Now they're wondering, is the economy stronger than expected? We've been seeing some economic reports coming out that are more market friendly, that maybe the economy is not so strong after all. Maybe the Fed won't end up having to raise interest rates. Okay, this is a little bit of a shift in this scenario that we've been seeing. We're still focusing more on Israel, what oil is doing, and then earnings as they are released. The dollar was down and interest rates were down, and both of these gave support to stocks. I'm kind of shortening up our list now. I'll still keep an eye on the 10 to the 5 and the 30 to the 5, and if they go back to looking crazy, I'll talk about them again. We still have the 10 to the 2-year and the 10 to the 3-month, which remain inverted. Sentiment is getting more positive. We're still in the negative camp at 42. We won't cross over until we get above 45, where we shot up from a reading of 33. Our trend is now positive. The green line has crossed back over the red line. However, the ADX is still below its moving average. So it's a weakening trend, but it is a trend. But now we default to the positive. Our bias is positive, and our momentum over the last number of days continues to be positive. The economic reports that came out, we had the non-farm payrolls, which showed growth, but it was less than expected. They thought 175,000 jobs were going to be created. It came in at 150. And another interesting thing is they actually revised down what we had last time. It was well into the 300,000s. Now it's at 297,000. The private payrolls also came in weaker than expected, but still showing growth, where they had expected 143,000. They also revised this down from last time to 246,000. The average hourly earnings, this is another area that the market really focuses on. They came in weaker than expected, being up 0.2%. They had expected 0.3%, or last time we did get 0.3%. The unemployment rate ticked up. It had been at 3.8%. Now it's at 3.9%. The work week came in as expected at 34.3. Last time it was at 34.4. And then the S&P Global Services PMI, the final reading, it came in just a notch above 50, showing very slight expansion at 50.6. Last time it came in at 50.1. So it's not too strong, but it's still above 50, and the market liked that. The other big one was the ISM non-manufacturing, also just a little bit above 50. It came in weaker than the 53% they thought was going to happen, but it's still above 50 at 51.8. Last time it came in at 53.6. I do have some charts. I don't show the jobs charts because they're so skewed by the COVID plunge. It's pretty much useless to look at those. But here's the year-over-year earnings, where they're just a little bit above 4%, but they are declining. And then the change month over month, where we did see a decrease, but still we're seeing growth. When things get really bad is when we see a negative result for the jobs that are being created. Here's the unemployment rate, which now has ticked up to 3.9%. Here is everything taken together. The red line are the initial claims, which are starting to turn back up. We're above the 4-week moving average. We're also seeing that with the blue line, which are continuing claims. That's going up. And the unemployment rate is now ticking up to 3.9. So we're seeing a little bit of weakness coming into the employment situation, but it's still quite strong overall. Here is the services PMI report that came out, shows us above 50 and advanced from the previous month. And then looking at the ISM services index, the total is the blue line, which did decline, but it's still above 50, and we were flat as far as prices, and the market liked that. We are declining as far as interest rates. We're at 4.51% for the 10-year yield, but we're still above that 4.02%, which could be biting into earnings for companies. Here's the intraday chart. It really looks very similar to what happened on Thursday. We gapped higher above R1, got above R2, and then just kind of like smoke coming out of a chimney, just drifted sideways. We did come down a little bit going into the close, but we were still above R2 and still held on to the gains without seeing an awful lot of selling coming in. But this is where we see some warning signs here. Both growth, well, actually growth was down just a little bit, but value is really outperforming growth right now. You can see the red line is well above the blue line. And we've been seeing that as we've been coming into this era of positive seasonality. We want to see the blue line on top going above the red line, and that's just not what we're seeing right now. Also, looking at the S&P growth to value ratio, it was down in the session. That's another warning sign. When we were really going down earlier in October, that's what was happening with this chart, and it's continuing to happen even though the market's going up. On an end of day basis, we're really dropping off, where growth is really underperforming value in the short term. Longer term, we're still in an uptrend, but we want to see this growth to value ratio turn and go up for things to remain more positive. We're also seeing a bit of a bounce here with discretionary. It's still in a negative trend, but it is bouncing back up. Staples are also starting to bounce back up. But in this ratio, we came right back up to the moving average. So this is positive. It's showing some signs of improvement. Here's the condition of the trend now, showing that the green line is on top of the red line. So that's positive. The ADX, the dark black line, is below its moving average. That shows it's a weakening trend, but it's still above 20, so we are still in a trending environment. And short term, also, the green line is going above the red line. We're below the moving average, but we're still above 20. We're also wondering if we're coming into this period of the average VIX where it's really starting to come down now. Are we coming more into the positive side of this VIX chart? The Ulcer Index is still giving us kind of a high reading, but it's starting to roll over. And here's the VIX, where it really went down, both with the line chart and the bar chart, and they're both below their moving averages. Volatility is also really decreasing as the market's been going up with the VIX of the VIX. And longer term, though, we haven't rolled over yet. When we look at the VIX to VVIX ratio, it's still going up. It's going to take some time for this to roll over if that's what happens. And the VIX to the 3-month average of the VIX, it's continuing to go up. Now, you can see the black lines are coming down, but it hasn't really impacted our red line, which is the moving average. And the VIX to move ratio continues to fall as stocks have been going up. Here's the equity put call ratio based on 5 periods. It's continuing to decline for right now, but longer term, it's still going up when we look at 253 periods. And this fear gauge just ticked up a little bit after it really had been falling. This other fear gauge is also declining. We're seeing a little bit of an improvement with the risk on, risk off ratio. It did tick up in Friday's session, but it's still in a longer term downtrend. The advanced decline line is showing improvement. We're back above the moving average based on price. We are improving based on volume, but we're still below the moving average. And we're turning back up as we're seeing an expansion of new highs and really no new lows in Friday's session in the S&P. So the 5 period is now turning and going higher, as is the 10 period. We're above 0 with our advanced decline ratio, both with the blue line, which goes faster, and the red line. That's showing a lot of improvement. We're also showing some improvement with the accumulation distribution above the moving average. The longer it can stay above this, the red line will eventually start to turn up. The Chaikin money flow, this is a little bit of a concern. It ticked off just a little bit. Maybe it's picking up some lack of smart money participation here, but we're still going up. The red line continues to go up, but to see this come down on a pretty solid up day is a little bit concerning. Looking at our chart, we're coming back up into this conglomeration of prices where we really stalled earlier on back in September. Is this going to produce some kind of resistance just based on price? We did close above the 50-day moving average. That's always a positive thing. And we're right about on this pivot line that you can see here that may be acting as overhead resistance. And then down on the bottom, we were still above average with volume. We're rolling over just a little bit. We're still above average with volume, but it hasn't been as strong or in the last couple of days as what it was previously. On a short-term basis, the force index is still hitting the upper Keltner band here, so that's extreme positive. The Stochk RSI is extreme positive. The Williams percent R. Now, these could all go further, and they could camp out here for a while. The CCI 14 is starting to get extreme positive, but as I said earlier, the 20 period is not. On a short-term basis, our stochastics are getting extreme. We're positive in the intermediate term, and we're just about ready to cross back above 50 with the long-term stochastics. And we're seeing some improvement here. This is our short-term rainbow going from 10 to 50 periods. The lines are still going down. It's going to take a while for them to react, but we're closing up at the higher end of the rainbow. And on a 5-period basis, when we look at the rate of change, we went up pretty far, pretty fast. I mean, look at the skyrocketing chart here where we're coming right back up to these previous prices. Yeah, the fact that it's going up is positive, but we have other things that we need to be concerned with as well. We're starting to go back up with our standard deviation. Again, this is not measuring direction. This is measuring speed of the stock, and this is going back up as prices have been going up. The Erin is just kind of out to lunch right now. It's flatlining. And then in a day or two, it'll kick into gear and go, oh, wait a minute, something positive happened. I better change. Well, it hasn't done that yet. And we're coming back up with our 20-period double and triple exponential moving averages, and both the green line and blue line are starting to turn back up. Shorter term, we are turning positive. And we closed above this mini rainbow when we look at the 20-period moving average of the high, open, high, low, and close. And the longer we stay up here, the more this little rainbow will begin to turn up. We're seeing a lot of improvement with the cumulative NYSE advanced decline line. We bounced up again in Friday's session, and we're above the moving average. With our regular NYSE advanced decline line, we are showing improvement, but we're coming right up to the moving average. And we're also still working off of a death cross here when you look at the trend of the NYSE advanced decline line, but it is showing some improvement. And the Swenlin trading oscillator, this was giving us a heads up. The only problem is it'd be nice to depend on this, but there are times when it fools us as well. It says something is happening that ends up not happening. Other times it was confirmed like it was this time. This started to go up before price started to go up. We're just barely under this extreme positive level based on price, and we're still positive based on volume. And I wanted to bring up the advanced decline line studies. A lot of times I just wait and go over this in the weekend, but we are showing some improvement with the NYSE common stock. We're crossing above the moving average with the S&P. The mid caps are back up to their moving average, and the small caps are improving, but still under their moving average. The go, no go system is changed to brown, where it had been a lighter shade of purple. It's picking up this positive movement, and this may redraw into something as price goes forward. The TTM squeeze is showing some improvement. It's a lighter shade of red and starting to go back up, but it's still negative. The balance of power just is remaining right in the middle right now. It was quite negative and showing some improvement, but to not see this go up on a pretty good up day, that's a little bit of a concern. We're starting to break above the midpoint with our highest high, lowest low chart here. We haven't come back up to this blue line yet, which could turn that up and make it go higher, but we are seeing the midpoint start to turn, and the red line, which is the lowest low value, that is starting to flat line out. We're still above the 200-day simple moving average. So longer term, we would switch back to positive. And we're bouncing off of this retracement. We got down to this little bit over 10% a week or so ago, and we've just been skyrocketing back up since then. The CMB composite is still looking extreme positive. The Connors RSI is still extreme positive. Our double and triple exponential moving average based on 50 periods, we are breaking out above both of these lines. Both of these lines are turning up, but to turn even more positive, we want to see the red line cross back above the blue line. Looking at our 50-period moving average study, where we were able to get above and close on the exponential moving average after Thursday, now we were able to close above the simple moving average on Friday. That's more positive. More people use the simple moving average, so they're taking this as more positive. And we're right in between on the 100-period moving average study. We have the exponential, which is the red line, and we have the green line, which is the simple. We were here before, not so long ago, where we were in between these two, but we're right at this R1 level if you're looking at the pivot points. And we're coming up above the 20-period moving average. Slowly but surely, if we can stay up here, these lines will turn and start to go back up. We're also getting to the point now with the Ichimoku cloud where we're coming into the underside of this red cloud. This may act as overhead resistance. The vortex is showing improvement, but it's still negative. The red line is declining, the green line is advancing, but the red line is still on top. The ease of movement is showing some improvement, but it's still negative. This is where we saw a big improvement here. The bullish percent index really shot up in Friday's session. And after giving us an extreme negative reading and crossing back above 30, this is a pretty positive sign. We're starting to get extreme positive with the S&P McClellan oscillator, but our summation index based on price and volume continue to go up. And we're also getting extreme with the NYSE McClellan oscillator. Now, you could take this two ways with both of these oscillators. Yeah, we're getting extreme, and maybe we've gone up a little far too fast. Or you could say, look at this momentum. The market is really kicking into gear. I would fall into the latter one where this is showing momentum if I was seeing more positive performance out of growth, which is just not happening, at least yet. But the summation index for the NYSE based on price and volume continue to go back up. We are positive with the S&P Elders Impulse system. The RSI is above 50 based on 14 periods as well as 9 periods and not extreme yet. On balance volume is just a tick above its moving average. If it can continue to go up, it'll turn the red line back up and turn things more positive. We are seeing a bounce of stocks in the S&P that are going above their 200-day moving average as well as their 50-period moving average. And we're coming back and closed above this 100% retracement level on our short-term fib chart. That is positive. We've been able to recapture that level. And we're also recapturing the 61.8% retracement level on this longer-term fib chart. That is positive too. And we came back up and we're showing more improvement where we broke above this double fib line in here, and we're kind of back into no man's land. If we stay up in this area, I'll probably stop showing this chart for a while. And we're above this resistance level when we look at our quadrant chart here. And these red areas are other areas of resistance, and we were able to close above those as well. On a momentum basis, we're starting to turn back more positive. The PMO is now looking positive, and based on price and volume, they are positive. We're starting to get extreme with the PMOs that are rising. We're positive with the buy signals, and we're turning up with the PMOs that are above zero. We're also seeing a nice little bounce out of the bullish percent index for the NYSE. This is starting to go back up. It's still below 50, but it is advancing now. This is where we're seeing a big improvement too. The NASDAQ 100 has crossed above 50 with its bullish percent index. Just a couple of days ago, it was giving us a reading right down around 30. So this is quite positive as well. On a momentum basis, our slope oscillator is starting to cross over positive after it had dropped below this red line, which oftentimes is extreme negative. The MACD is looking more positive, and all of our oscillators are starting to turn back up. We haven't quite crossed yet with the TRIX or the KST. These are our longer-term oscillators, but this chart is showing a lot of improvement. We haven't necessarily gone up too far too fast with our standard deviations chart. We're above the midpoint is starting to turn back up. We closed right on the border between the +1 and +2 standard deviation. Now we're just kind of at the upper end of the +2 standard deviation. When we get more concerned, according to this chart, is when we get up into the +3 standard deviation. We are looking more positive with the Chaikin oscillator. We're above zero and advancing. The money flow is kind of stalling out. It's just a little bit above 50, so it's positive, but it's not really showing any strength right now. The ultimate oscillator it's above 50 and advancing, and we're still positive with the parabolic SAR. We saw that switch after Wednesday with the dots underneath, and that is, in my opinion, a major signal. But we're coming right back up to the underside of this trend line. This is a long-term trend line going from the March 2023 low. We couldn't quite get above that. This could end up being some kind of a resistance level. But when we look at Dow theory, we were up with the Dow, we were up with the transports, and we were up with utilities. But the transports, even though they're bouncing back up, they still continue to underperform the Dow. And we're not really seeing this ratio. It ticked up, but we want to see this just screaming going higher if we want to turn more positive. That's another potential warning sign. And we actually came down a little bit, showing that transports outperformed in Friday's session, but this has been really climbing overall. Another warning sign. We want the transports and the growth stocks to be stronger than they have been. The Zohorchak, and again, this is delayed. This is as of Thursday. It hasn't gone back up to a full-blown buy signal yet. And this is actually looking a little bit more positive here. When the staples are going down, which they have been doing the last couple of days, that is giving good support to the S&P. Then the inverse of that, when we look at the utilities, we want to see this ratio going up. That will give support. We're actually seeing this ratio going down, even though it ticked up a little bit on Friday. Another bit of a warning sign. And there's always something to worry about. Nothing is ever going to be perfect. In fact, about the time everything does line up to be perfect, that's when we switch and go in the other direction. The market likes to climb a wall of worry. Looking at our 10-day average of the S&P 500 highs minus the lows, after giving us a couple of extreme negative readings, we are starting to bounce up out of that. That's longer term positive, and we're crossing above the zero line based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. This is turning more positive, and we're bouncing up with the micro caps. They're still below the 100 level, but they have been bouncing with small caps. The hike in ASHI is turning more positive. The KEGI is turning more positive with the black line pointing up. The Renko is turning more positive with open blocks, and the 3-line break is turning more positive. We did have a new X drawn in here with the point and figure chart, and X's mean the price is going up. And this is working off of a signal that was generated on Thursday of a low pole reversal. All right, so that's looking more positive again. We are seeing some improvement with the equal weight index as well as the S&P 500 weighted index. But overall, the equal weight is underperforming, and we're seeing a little bit of a decline here with our ratio between the S&P and the equal weight S&P. You can take that a couple of different ways. This just means that more stocks are participating, and so this ratio is going to come down. But the fact that this has still been going up overall, and the bigger stocks have really been leading to the market advances in 2023. The Dow was able to get back above its 250 period moving average. That's positive. We might be able to avoid a death cross here if price can stay above that. And we're positive with the Elder's Impulse system for the diamonds. And we're coming back up to a resistance level here with R1. We tried to get through that in Friday's session, this R1 level. We did get back above the 50-day moving average with the NASDAQ 100, but we have some pretty significant overhead resistance here. That's what stalled us out back in October. And then we really started to decline after that. So we want to be able to break through this and really move for this to turn more positive. But we are positive with the Elder's Impulse system for the QQQs. And we're looking more positive with momentum for the NASDAQ 100. It's starting to cross above its moving average and it's going up. It's still below zero, but it is starting to turn positive. And we're above the 61.8% retracement level for the NASDAQ 100. If we stay up in this area, I probably will drop showing this chart for a while. And we're back above the 50-period moving average with the NASDAQ, but we're right below this R1 level, which is providing overhead resistance. So this is showing a lot of improvement, but we need to get through these areas that have caused problems not so long ago. And we're above the 50% retracement level for the Fibonacci readings on the NASDAQ. That's positive. But a lot of times, see how we came down and just bounced off of that? Well, we chopped above and below it for quite a while. Let's see if we can stay above this and possibly go back and test this 61.8% retracement level. The small caps were really up. They came all the way back up to their 50-period moving average, but they're still in a longer-term death cross. But man, they just shot up on Friday. And when we look at the Russell 2000 small caps, we're above 50 and advancing with the RSI. That's positive. We're coming up to the 50-period moving average. That could be overhead resistance. And on a momentum basis, we are positive. Also, when you look at the price chart, we were able to recapture this support level that had been broken earlier in the week. We're positive with the Elder's Impulse system. And look at the size of this gap. My goodness. And the mid caps also gapped higher, came right up to R1, coming up to their 50-period moving average. So it also has some overhead resistance. The mid caps for the Elder Impulse system, though, still remain positive. The FANG index was able to get back above its 50-day moving average and close above that. That's positive, and we're also in a longer-term uptrend. And the FANG, and this is another chart that I'll probably stop showing now. We're kind of out of these areas unless we really start to fall. But these other areas that were lows, intraday lows, those held up, and now we've been starting to go up higher again. ARC, just want to show this because so many people own this. We're still working off of a recent death cross, but it had a pretty good week too. It's coming right back up to its 200-day moving average. Looking at the weekly chart of the S&P with our arithmetic scale, we did close back above that. That's positive longer term. But here's where we start to see some issues here. The QQQs to the S&P, nothing really spectacular. In fact, it turned down a little bit. A little bit of a tick up with discretionary to the S&P, which had been weaker. So this is more positive. When we look at large cap growth versus large cap value, it actually ticked down. So on a large cap basis, we are showing some improvement. We're chopping sideways with the mid caps. We're still showing weakness with the small caps. And this is showing some improvement. We're ticking back up with our longer term new highs, new lows indicator. It is ticking up, but it's below zero. We've spent 2 days above zero now with the black line, and that eventually, if we can stay there, will turn the red line back up, but it hasn't really done that much yet. When we look at the 50-period moving average study, the S&P, after getting extreme negative, we're now crossing above 50. That's kind of the line in the sand between positive and negative. We closed at, 56.4. And the mid caps are showing some improvement, crossing back above 50. And the small caps are also showing some improvement. Now, both with the mid caps and the small caps, we didn't get an extreme negative reading. We got a very low reading, but it wasn't necessarily extreme. When we look at the new highs and new lows, and we take a 5-period moving average of that and spread it out over the whole market, we're still below zero, but we are showing some improvement. The dollar was down, actually down kind of significantly, over 1% in Friday's session, and that gave support to stocks, but longer term, it's still in an uptrend. The financial sector was able to get back above its 200-day moving average as well as its 50-day moving average. So this is seeing a little bit of love lately. And this support level also held. And this is another chart where if we stay above this, I'll probably drop this from the videos for a while. This is what really helped stocks. We saw a massive move down in the 10-year yield, and it was a lot lower than it ended up closing. But the fact that rates are really coming down has given a lot of support to stocks. So we're seeing prices going up. The RSI is above 50 and advancing. We are seeing some positive movement based on price, even though we closed at the low. And on a momentum basis, we're also seeing the MACD going higher, but we're working off of a recent death cross. And bonds have been under a lot of pressure. So some of this might be an oversold bounce. When we look at the 10-year yield and subtract the German 10-year yield, we're starting to come down now, and the dollar was down, but the correlation between the two continues to be really strong. I still haven't received the latest research from Tom Bowley. I'll be sure to post that whenever I get that. So what's our outlook for Monday? We're still dealing with earnings season. We're still dealing with the situation in Israel. We have a weekend to go here where we'll see how things play out. The technicals are positive, but in the short term, we're becoming more overbought, extreme positive. We won't have any economic reports on Monday. We're watching the geopolitical events. Yes, there's still a war going on between Russia and Ukraine. It's just been replaced by everything that's going on in Israel. Here is the calendar for the upcoming week where we won't have any reports on Monday. Nothing all that major coming out. So we'll kind of take these in total to see how things are going economically. And then looking at the Stock Traders Almanac statistics for Monday, we are positive across the board. We're up 71.4% of the time with the Dow and NASDAQ. We're up 81% of the time with the S&P 500. So we will be on the 4th trading day of the month. Now, the green dash line, that's during a pre-election year, and that's also positive. Where somewhere buried in here is the solid green line where it tends to be positive. And it looks like, coming back into this green area, which shows some positive movement during a pre-election year. Also, we're coming into this positive area based on this seasonality chart. And the NASDAQ is also showing some improvement here, but it does get a little choppy as we go throughout the month of November. And also a little bit choppy later on with the green line with the S&P 500. And Bitcoin, it's kind of doing okay here. It got up into the 36 area on a high basis, but then closed down in about the mid 34,000 range. So the scenarios, we can't go with the down one right now. We just don't have anything to really support that other than overhead resistance and other than we are overbought in the short term. So we're leaning towards the positive side right now. We're not going with the sideways trend. Even though the ADX is weakening because it's below its moving average, it's still above 20, so that counts as a trending environment. The warning signs, and this is a bit of a concern, and we've been seeing this for a few days now, so I added this point. Growth is underperforming during the recent rallies that we've been seeing. We want to see growth doing better than it has been. This could change, but it hasn't changed yet. The daily special K chart continues to be negative, and now that we're further below that red line, I'm not going to show that chart for a while. The longer-term equity put call ratio is still going up. That's negative. The risk on posture, yeah, it bounced up, but longer term, we're still showing weakness. The vortex is negative, but showing improvement. The red line's still on top there. Our longer-term new highs, new lows study continues to be negative. The Russell, the small caps, and the mid caps are working off of recent death crosses. The financial sector generated a death cross a week ago, but now was able to close back above its 200-day simple moving average. If it can stay above that, that death cross may be short-lived. We'll have to see. The positive signs, our 5-period equity put call ratio continues to decline, and that's positive for the market. We're switching over, and this is a new addition to the positive side. Our oscillators for the S&P and the NASDAQ 100 are turning positive. The parabolic SAR as well as the BPI, they are looking more positive now. Small and mid-cap growth, even though it's chopping sideways, it continues to be in a longer-term uptrend. So our conclusion, we're positive, but we're becoming short-term overbought, and we're dealing with some overhead resistance, not just with the S&P, but look at the NASDAQ 100 and see the overhead resistance that there is playing out on that chart as well. In the short term, we're positive, but could be dealing with resistance at an overbought condition. We're turning more positive in the intermediate term and have some indications that we're extreme positive. And we continue to be positive in the long term because we're back above the 200-day simple moving average. Thank you. I really hope you found this helpful. I will be putting out the weekly video and the intermarket analysis video, as well as the deep dive video. I hope you're enjoying the new Beatles song, and I will talk to you in the next video.